UNLV Microcertificate Economics. We're going to fairly quickly try to talk about the crisis of 2007, 8, 9, a whole bunch of related stuff that has to do with banking. Your students don't remember it, my students don't remember it, but it's got a lot of useful lessons in it. Okay? So the trigger for this is the simple fact that people all over the world do not like to invest in their own countries. They like to give their money to the United States and invest it in the United States. So we had something like $900 billion a year of money flowing into the United States for investment purposes, most of it from China and the Middle East. That's Bernanke. He was chair of the Federal Reserve, and he saw all this money coming in, but thought that the system could handle it. Where does it go? Well, the answer is it's hard to find places for all that money to go, so Wall Street had to invent new places for it to go. And the easiest way to do that is to use something called a derivative. A derivative is a financial instrument backed by another financial instrument. So where my mortgage is backed by my house and my car payment and car loan is backed by my car, a derivative would be a piece of paper that's backed by my mortgage or my car loan, not by the car or the house. It's a second layer or a third or fourth layer. Okay? Since 1999, these have been unregulated, and banks are very creative in how they figure out how to create these things. So the most common kind we had is something called a collateralized debt obligation, or a CDO. Mortgage-backed securities that we'll talk about are part of that. It's an IOU used to create another IOU. So I already owe money on my house, but you take the fact that I owe money on my house to create another IOU. So let's say I'm paying $1,000 a month on my house. The bank can turn around, go to an investor and go, look, I will sign over that $1,000 a month if you will loan me $300,000. So they loan me $200,000 for my house. They get $300,000. You with me? There's all kinds of things that they can do. A bond is just a loan that happens without a bank. So they're creating these bonds without having to go through a bank. They're just making these loans. Okay? Remember, a traditional home loan, if you own a home, the bank loans you money. You agree to pay it back, usually over 30 years, sometimes over 15. That's the way it used to be, where there's this traditional relationship between a bank and the person who bought the house. And the bank figures you're only going to keep your house 5 to 7 years anyhow, and they're going to roll it over, and they're going to deal with it other ways. But now, let's suppose that the bank has all this money from China that it wants to do something with. Well, how can I get tricky here? Well, the answer is create this CDO, securitization. So, bank loaned me $200,000. I'm paying $1,000 back a month. The bank borrows $200,000 from a guy in China and pays them $800 a month. See how the bank's coming out ahead? They had $200,000. They loaned it to me. I'm paying them $1,000 a month. They went to China, borrowed $200,000, and they're paying them $800 a month. So the bank started with $200,000. It ends with $200,000. It's got $1,000 coming in. It's got $800 going out. Basically, it's got $200 a month in absolutely free money. Okay? And it can do this over and over and over again. So just in this 4 examples, the bank started with $200,000. It ends with $200,000, but it's making $800 a month profit, but got its money back, right? It's got, yeah. And now imagine doing this 1,000 times, 100,000 times, 500,000. There's a lot of money. Investors want more bonds. How do we get more bonds? Well, we need more mortgages because it's the mortgages that we're using to create the bonds. How do we get more mortgages? Well, we go to this company called Countrywide that makes money not off of the mortgages, but off of the fees. So it creates a mortgage. Its plan is to sell the mortgage. It's not going to hold on to the mortgage, and it's going to profit from the fees it gets from doing all this business. So everybody it deals with, it charges them thousands of dollars in fees, and it's making its money off the fees. So now we're going to do some wild structure of these home loans. We're going to go to someone and say, look, house prices are rocketing up. They're going up. This is, again, 2003, 4, 5. House prices are just shooting up 20%, 30% a year. We know you can't afford to buy a house, but we'll make you a loan anyhow. Here's $1 million loan. And you only have to pay us $300 a month for 3 years. But imagine that house, that $1 million house that you're buying on your $20,000 a year income, that's going to be $1.6 million or $1.8 million 3 years from now. You sell it, you turn around, you just made $600,000 profit. Isn't that cool? Now you can actually go buy a house. So they got all these people who couldn't afford to buy houses to buy houses. Tons and tons of them. Okay? By coming up with creative mortgages and lying on the mortgage applications. Literally, they trained their staff to lie. And nobody went to jail for this, mind you. They should have, but they didn't. Then, the other side of this is, within our financial system, there's what we call a shadow banking system. There are things like hedge funds that act like banks, but aren't. And those things are unregulated, right? They get to do this business without the government looking over their shoulder. And then the stock market. How many stock markets are there in the United States? Well, the answer is, last time I looked, there were more than 40, right? And a lot of them are kind of hidden. So if you go and buy a share of stock, if you tell your banker, hey, I want to buy 10 shares of Apple, your stockbroker, you have no idea what market they're going into, whether you're getting treated. There's all kinds of stuff in there, and we don't have time to go through it all, but there's all kinds of messed up stuff that can happen in there. And the transactions are all happening electronically, and there's businesses out there whose whole business is to screw around with the transactions that are happening. And so not our purpose right now. But here's a picture of Franklin Roosevelt signing something called the Glass-Steagall. Now, there was a set of acts. We usually call it the Glass-Steagall Act, but that's okay. It separated financial institutions by function. What happened with home mortgages in the 2000s, in the 1920s, that was going on with the stock market. So let's say you made, $20,000 a year in the 20s, but you would go out and borrow $500,000 to put into the stock market. Well, why would they loan that to you? Because you would use the stock as collateral. So you would go out and you'd buy 500,000 shares of stock. And everybody knew that the stock market would just keep going up. And so the bank didn't worry about you taking out this huge loan that you could never repay because they knew the stock was there. Well, now the stock market crashes. People can't pay the loans. The banks are going bust. It's a mess. So one of the things that the Glass-Steagall Act did was it separated banking and stock markets. Banks couldn't get involved in the stock market. Stockbrokers couldn't do banking services. Okay? Created the FDIC, the Federal Deposit Insurance Corporation that we talked about. In the 7 years before Glass-Steagall, there were no financial panics. And there were 4 financial panics. 4 in the 7 years before. Glass-Steagall is in effect for 70 years. There are 0 financial panics. The United States does not have a single financial panic when Glass-Steagall is in. 15 years after repeal, financial panic. But the other side of that, and here's Bill Clinton signing the law, which was written by 3 Republicans, Graham, Leach, and Bliley. Bill Clinton signed it. It passed unanimously in the House and almost unanimously in the House and Senate. What passes unanimously in the House and Senate? But this did, because the banking industry are huge contributors to both the Democrats and the Republicans. So this law passes. We repeal Glass-Steagall. Okay? The problem with Glass-Steagall is that it's keeping U.S. banks small, and it's keeping them from dealing with multinationals. So all the big U.S. corporations have to have a bank which is not a U.S. bank. Well, the United States needs to be the leader in financial services. It can't run around in a world where its banks are tiny and are unable to deal in a real strong multinational sense. So that's the impetus to repeal Glass-Steagall. There were other ways, obviously, they could have done it. And it permitted this expansion of financial derivatives and said the government can't regulate derivatives. So we had a crisis in 2007, 8, 9. Banks made bad home loans. Banks turned the bad loans into bad bonds. Banks bought insurance on the bonds because they knew they were bad. So the bank's issuing these bonds, we know they're bad, but I'm going to go get an insurance company to insure these bonds, which means I, the bank, have no risk. I have covered myself. I have put the risk onto the insurance company and the homeowner and the person who bought my bad bonds. So the bank is protecting itself. Lehman Brothers goes bust because its bonds are bad. But the company that insured them, AIG, insured so much it can't afford to pay, and it goes bankrupt. So the whole insurance scheme now falls apart. And these insurance policies, right, are called credit default swaps. They're essentially insurance policies on the bonds. They go bad. The financial system freezes up. Right? The government said, look, we want to be, Adam Smith here. We want to just let things settle out, let the market clear this out. Well, the market didn't clear it out. The whole global financial system froze. Global financial system froze. And the government had to step in. Okay? So, just some things to think about. The first time the U.S. did a bank bailout was 1813. So it's not like we've never done them before. We've been doing them almost the entire history of the United States. We've been bailing out banks. Okay? We paid J.P. Morgan to buy Bear Stearns, which went bankrupt. IndyMac went bankrupt. We paid them off. The government had to take over Fannie and Freddie, the companies that do the mortgage loans. The government cost our taxpayers, us, $200 billion. We bought AIG. The government owns it. The taxpayers actually pretty much got their money back was the government sold that off. The government created a $700 billion program called TARP, which was to buy toxic assets. That's what the TA stands for. The government didn't buy any toxic assets, but they still spent the money. And then we bailed out GM, we bailed out Chrysler, we bailed out Merrill Lynch, we bailed out Washington Mutual, etc., etc., etc. Okay? There were 5 investment banks in the United States, 5 major investment banks. Lehman went bankrupt. Merrill Lynch, the taxpayers paid Bank of America to buy Merrill Lynch. The taxpayers paid J.P. Morgan to buy Bear Stearns. And Goldman Sachs and Morgan Stanley were forced to become commercial banks so that they'd be under the Federal Reserve. We created a law to deal with this. That law is called Dodd-Frank. It's more than 2,000 pages long. It's well-intentioned, much too long. There was weak financial, and this is Obama signing it, obviously. We had weak regulation. There were too many government agencies. There was what we call a too big to fail problem. If Bank of America has 10% of all of the deposits in all of the banks in the United States, you can't let it go bust. It's too big. Right? And if I'm Bank of America and I know the government can't let me go bust, well, I might take risks I wouldn't take otherwise, right? And then we have this shadow banking problem that there's all this stuff that goes on that's outside. So they created some rules. The best one of those is called the Volcker Rule, which in the draft version of this law, it's only 4 pages long, but it gets turned into 70 pages long. It's named after Paul Volcker, who was one of Obama's advisors and also a former chair of the Federal Reserve. Volcker Rule just says if you issue a bunch of bonds, you have to keep some of them. So it discourages banks from issuing bad bonds because they don't want to have to keep them. Gives more power to some of the federal agencies, brought more people under Federal Reserve, created the Consumer Financial Protection Agency. Elizabeth Warren was responsible for that. Yes, and so it's been weakened and weakened since. Some other stuff has gone on. So that's the story. Yes, did we enjoy it?